Good morning. Good morning, everyone. Brent the Broker here, Monday, April 13th. I just wanted to provide a quick update, kind of more on what we're seeing with the real estate market is doing. We're going to kind of try to keep it short and sweet. I know you all are very busy and you need the info. So let's go ahead and get to it. So as we've been discussing, recession, which is pretty well unanimous that we are now entering a recession. Recession does not mean a housing crisis. I've had a lot of clients call me and saying, oh, we're going to wait and, we're going to see if we can get some cheap real estate, after this slowdown ends and things of that nature. And, there are some other smart people who think that real estate values are going to depreciate, meaning go down. And while we do see a deceleration of pricing, meaning they're not going to go up as fast as we thought it would, we do, and the people that I follow and trust, we seem to think that real estate prices will remain stable and probably on an upward trajectory through the end of this year and certainly through next year as we recover fully from this virus pandemic. So let's talk a little bit about why and who these people are, and we'll try to keep it short and sweet. Recession does not equal a housing crisis. Okay, there we go. So with the exception of two recessions, 2008 roughly and 2001, no other recessions have impacted the housing market, according to Freddie Mac data. Wells Fargo Investment Institute says we do not expect a repeat of the severe recession of 2008 because the virus and oil shocks are not endemic to the financial system, meaning they are not a part of, but rather they're external. Once the virus infection rate peaks, we expect a recovery to gain momentum into the final quarter of this year, 2020, and especially into 2021. So what does that mean? That means that this current recession and the current disruption that we're seeing in the financial system has more to do with things coming from the outside, the virus, the oil shocks, things of that nature, rather than being an issue with the financial markets like we saw in 2008, with everything that was going on with lending practices and stated income and, mortgage-backed securities and the issues that went on with the production of those securities. And we're just not seeing that today. So the pressure that we're seeing on the market is external. So that, according to David Rosenberg, who's a respected economist, he says that this current situation has more to do or more in common with 9/11. It's a shock that's generated fear, angst, anxiety amongst the general public, and people are avoiding going out in crowds like they did when they were fearful of terrorist attacks. And the same parts of the economy are under pressure: airlines, leisure, hospitality, restaurant, and entertainment, consumer discretionary, which does not include housing. So let's look at the last five recessions. So 1980, 81, 91, 2001, and 2008. Now, everyone remembers 2008 being so recent and the housing market sort of driving the 2008 recession or being a big participant of it. But if we look at the past four recessions where housing was not a driver of the economic downturn, you see in 2001, which Rosenberg compared this to, housing actually went up 6.6%. And in the other recession where it did go down, it only went down 1.9%. And this is according to CoreLogic national home prices. So of course your local mileage may vary, but we like to look at this stuff from a macro perspective, and then get with your real estate agent. If you're in San Diego, Southern California, you can call me and I can get you your local information. But that's kind of what has gone on during the recession nationally. So another thing that we are concerned about is we're seeing the stock market go down quite a bit this year. And I don't remember what it's at year to date. I think last time I checked, it was down about 25%. So in the 2007 to 2009, the S&P 500, which is sort of the benchmark for the US stock market, went down 51%. And over that same period, you can see homes actually did depreciate to the tune of almost 19% during that 3-year stretch. So it's understandable why we have this residual fear that when the stock market is imploding, that housing is going to implode with it. However, again, the experts that I follow are saying that this is not the same as 2008. It's more to 2001 where there was external pressure. And let's see what happened when the market melted down in 2001. So if we look at the data, again, the dot-com crash and 9/11 crash kind of happened in this 2000 to 2002 window of time. And people are saying that that's roughly the equivalent of what we're seeing with the oil, oil prices dipping, and then of course this virus. So we've got two things that are outside of our market that are sort of driving this. And the stock market went down, the S&P 500 went down 45% over this period of time. But you see the home prices actually appreciate, and they appreciated quite well over that 3-year period of time, where we were up about up over 20% in aggregate over that period of time. So as you can see, the stock market going down and us being in a recession, all a recession means is that the gross domestic product, the amount of economic activity in the country, is shrinking in 2 consecutive quarters. But that could be for a variety of reasons. It could be a variety of industries. And what we're seeing, and the people that I follow are saying, that housing is not going to be one of the industries that's severely affected by these 2 other factors. Another reason why, home prices, it all has to do with supply and demand, right? So back when in 2008, what happened was we saw an influx of supply, and the reason was people were borrowing money against their houses like crazy. So when the housing market depreciated, people found themselves owing more on their homes than the house was worth. So it was easy for people to just walk away, throw the keys to the bank, do a short sale, get foreclosed on, and just move on with their life, because there's no money there. So you're just walking away from an asset. Today, we are seeing much more equity in homes, and we are seeing much less cash out refinance. So there's more incentive for people to stick around and try to stay in their homes. And we're not going to see a large influx of foreclosures because people aren't just going to toss the keys back to the bank when they got 25-30% equity. So that's another data point that we feel is working in housing's favor. Another reason, going again, supply and demand, the housing sector enters the recession underbuilt rather than overbuilt, which means as the economy rebounds, which it will at some point, housing is set to help lead the way out. So essentially what they're saying is that there's not enough inventory to keep up with the demand. There's not enough homes for sale, and anybody that's been in the market either as a buyer or a seller in the last 5 or 6 or 7 years has definitely felt this squeeze on inventory. And I think we're going to continue to see that as we move forward and as we move out of this pandemic. So here's just a good example of that. There was 8.2 months of inventory for sale in 2007 compared to 3.1 today. And all that means is at the rate people are buying homes, how long would it take for them to buy up all of the available homes on the market? So in 2007, that metric was 8.2 months, and today it's 3.1 months. And as you can see that another version of that data point here, and you can see leading up into 2007, 2008, we saw a huge influx of supply. And as most of us know from Econ 101, as you increase the supply without increasing the demand, prices are going to eventually depreciate, and vice versa. So you can see when we have 6 to 7 months, this gray bar, that's considered about a neutral market. So the leverage for buyers, the leverage for sellers is sort of about an even playing field. Now, looking at 2010, when we had our spike, there's a slew of foreclosures and short sales, and there's all this supply coming on the market. Also, the lending practices really tightened up after the crash, so it was harder for buyers to get loans and get into the market. So there was a variety of factors that caused inventory to spike in 2010. And as you can see, that's when it was a buyer's market. Anybody that was shopping around in 2007, 8, 9, 10, it was pretty easy. You had your choice of homes at pretty fair prices because the sellers, didn't have much leverage. As you can see, as inventory dwindled into the last handful of years, you can see that we've been in a seller's market, and we do believe that there won't be an influx of homes like there was last time, and the low interest rate environment and some other economic factors will cause buyer demand to remain steady. What does that mean? So if you're in a seller's market, that means there's more demand for homes than there are homes for sale, so prices are going to appreciate, and that's what these people are expecting to continue for some time. But Brent, unemployment is going crazy. People are going to get foreclosed on. Of course, we're going to have a similar situation. Well, unfortunately, or fortunately, depending on who you are, us as a society and the United States government have really wised up to our past. And what happened is this time around, I don't believe, and we have some indication, but I don't believe that the government is going to allow foreclosures on the mass scale that they did in 2008. I don't think anybody was really prepared with what the foreclosure crisis was going to do to the economy as a whole, considering the housing market is responsible for the residential housing industry or maybe it's the real estate industry on the whole, is responsible for something like 20 or 25% of the GDP of this country. So I think after the last crisis, we realized that we can't just let foreclosures go on unfettered, because it's just not going to allow our market to stabilize and allow people to move forward and allow our country to move out of recession if housing is so negatively impacted. And you can see the Federal Housing Administration has already enacted moratoriums on foreclosures, and we expect to continue to see forbearance arrangements and foreclosure moratoriums. And the long and the short of it is the government is getting out ahead of this and learning from their past mistakes. And I think the government's going to continue to try to help people stay in their homes with the experience that we had last time and not allowing that to happen. Ali Wolf, chief economist with Myers Research, says this is the Great Recession for leisure, hospitality, trade, and transportation. In this recession, we'll feel as bad as the Great Recession did to housing. Last time housing led the recession, this time it's poised to bring us out. So again, even though we are seeing some sectors of the economy contract, there are always going to be other sectors that are expanding, and this time housing is going to be one of them. That's what these smart people are saying. Another reason we have to believe is that the average mortgage payment as a percentage of income is historically low. You can see the historic norm is on average 21% of a person's income is going toward their mortgage payment. And as of January of this year, that ratio was down to about 14.8%. So we are seeing a lot of affordability and just a lot. The data points that we look at to determine whether there's going to be an influx or supply and demand, which is what affects prices, many, if not all of the data points are pointing to continued appreciation of housing. So again, my whole argument here, my whole thesis, so to speak, is that housing prices aren't going to go down the way people are thinking and saying they are. And so trying to time the market to find a screaming deal, I just don't think we're going to see that. And if you wait too long, the economy is going to snap back and we're going to be right back to, an influx of demand and houses moving much quicker than maybe they are now. So I think it's a good time to buy now, because I think as a buyer, you're going to have some options. I think homes are going to sit on the market a little bit longer, the ones that are on the market. And, I just don't think timing it for waiting for a drop this year, based on the data that we're seeing and the people I follow, I just don't see that happening. And here's another data point as to why. Harvard Business Review says it's worth looking back at history to place the potential impact of the virus. And it says V-shapes monopolize the empirical landscape of prior shocks, meaning the GDP might go down. The economic output of our country is going to go down in a hurry. But once the coronavirus, once we're cured from that or beyond it, we're going to see everybody get right back to spending, and we expect to see GDP increase sharply, including the pandemic, epidemics such as SARS, the 1968 Hong Kong flu, the 1958 Asian flu or H2N2, and the 1918 Spanish flu. So we have seen V-shapes monopolize the empirical landscape, meaning that the V-shaped recovery, the quick down and the quick back up, tends to be pretty common for epidemics and pandemics such as we're facing. John Burns says historical analysis shows that the V-shaped models, again, sharp recessions that recover quickly enough, provide little damage to home prices. And some very cutting edge search engine analysis by our information management team showed that the current slowdown is playing out similarly thus far. Again, these are just bright people who have quality data, who know how to analyze it, bringing us this information. And I'm just trying to do my best to bring it to you in layman's terms. These are the people that I tend to align myself with when I'm looking at the markets for myself. And again, this is just more information as to why we don't think that there's going to be a giant downturn. Ivy Zellman of the Z Report, again, another noted economist in our industry, they did some analysis, and it says, we expect home price appreciation to decelerate from current levels, though easily remain in positive territory given the beneficial factors of low inventory, so low supply, and historically low interest rate environments which will buoy demand. So what she's saying is home price appreciation is going to decelerate, not depreciate, and there is a difference. And the difference is this. Originally in 2020, before COVID-19 showed up, home price appreciation projections, it was projected nationally to increase about 4.7, and they've adjusted that down to 3%. So what they're saying is, yes, we do expect home price appreciation to slow down. So we're not going to go up 4.7% this year, but we still should be in positive territory due to these other factors. And as you can see in 2021, with the expectation being that we've beat the virus by then, they've adjusted their projections for 2021 to be around 3.8 to jump up to 4.2. And we see a continued projections for appreciation in 2020 as well. Again, unemployment, we can't get out of this conversation without talking about unemployment. So projections for the peak rate in 2020, Goldman Sachs thinks it'll be about 15, CBO thinks it'll be about 12, and JP Morgan thinks it'll be about 8.5. So there's all these projections of where people think unemployment is going to be. So the question is what will it be? Who really knows? But what does unemployment do to housing sales? And there's just a chart showing the current unemployment rate compared to past financial crises. And you can see from 2008 to 13, it was between 7 and 10%. And they're expecting a spike this year. And then the projections, Goldman Sachs projections, again, subject to change, for next year is about 6.6 to 8, and then dwindling back to sort of a more normal number going forward in 22 and 23. And what this chart shows you is that unemployment rate and home sales do not have a direct relationship. So you can see the unemployment rate, the yellow line, and the existing home sales in the bar graph. And you can see that they don't move in lockstep. There have been times where unemployment has gone down and housing sales has increased. There have been periods of time where unemployment has increased and housing sales increased. There have been times where unemployment has increased and housing sales sort of stabilized or decreased. And there have been times where unemployment has gone down and housing is sort of bopped around, mostly stable, a slight increase. So unemployment rates do not have a direct relationship on home sales. Now, will it affect things? It could, and I think you see that in the projections of depreciation and the projection of overall home sales. But the question and the what's the word I'm looking for? Not thesis, but my hypothesis is that home prices will not decrease substantially. I don't see home prices depreciating, decelerating, sure, but depreciating, I don't think so, based on the data that we see and the experts that I follow. And again, so when we go back to this graph and say, well, Brent, if enough people lose their job, people aren't going to be able to make their payments. There are going to be foreclosures. There are going to be this. There's going to be that. Again, I go back to this slide because the government is stepping in and they are not going to allow 2008 to happen all over again, because I think we realize how important housing and keeping people in their residential properties and maybe across commercial properties as well, not my specialty, but you can see the Federal Housing Administration and the Federal Housing Finance Agency, Fannie Mae, Freddie Mac. The government is going to step in and do whatever they can to mitigate a rush of supply and depreciating prices, because it's such an important factor to lead us out of the recession that I think it's going to get a lot of attention. So that's sort of my my hypothesis, that I don't think you're going to see a huge depreciation in home prices. Things will probably be steady. The number of home sales will probably slow down, but based on the data that we're seeing and the experts that I follow, I think housing prices are poised to remain stable, and I think that it's probably one of the sectors in the economy that are poised to lead us out of this recession as soon as we can conquer this coronavirus. So I hope everybody out there is staying safe. If you have any questions, concerns, comments, challenges to anything I've said here, I'd love to hear it. Obviously, nobody can predict anything, but we're trying to give you as much up-to-date information as we can from people that are way smarter than me. Hopefully, I can go get it from smart people and deliver it to you, so you can use it to make a wise decision for you and your family. Call me if you have any questions or concerns. Slide into my DM, 619-550-8070. 619-550-8070, and I will look forward to seeing you all soon. Thank you.